Let me tell you something that keeps me up at night, something that most people in the financial industry are too afraid to say out loud. We are sitting on a real estate time bomb, and when it goes off, it could trigger a financial collapse that makes 2008 look like a minor correction. I have been in banking for over 40 years. I have seen every crisis you can imagine. The savings and loan collapse in the late 1980s, the dot-com bust, the 2008 financial crisis that nearly brought down the entire global economy. I was in the room when decisions were being made that would determine whether major institutions survived or failed. I have watched trillions of dollars in wealth evaporate seemingly overnight, and I can tell you with absolute certainty that the warning signs I am seeing right now in the real estate market are more concerning than anything I witnessed before 2008. Most people do not understand how interconnected the real estate market is with the broader financial system. They think of real estate as separate from stocks, separate from banks, separate from their retirement accounts. That is a dangerous misconception. Real estate is the foundation upon which our entire financial system is built. When that foundation cracks, everything else comes tumbling down. Let me take you back to a moment that changed how I think about systemic risk forever. It was September of 2008. The world was falling apart. Lehman Brothers had just collapsed. AIG was on the verge of failure. Banks were refusing to lend to each other because nobody knew who was solvent and who was not. I remember sitting in meetings where we were trying to figure out how to keep the entire financial system from seizing up completely. The root cause of all that chaos was real estate. Specifically, it was the mortgage market. Banks had made loans to people who could not afford them. Those loans were packaged into securities and sold around the world. When the underlying mortgages started defaulting, it created a cascade of failures that nearly destroyed a global economy. We came closer to a complete financial meltdown than most people realize if certain decisions had not been made, if certain institutions had not been saved. We could have woken up to a world where ATMs did not work, where paychecks did not clear, where the entire modern financial system simply stopped functioning. I learned from that experience that real estate is not just another asset class. It is the cornerstone of financial stability. And when I look at the real estate market today, I see cracks forming in that cornerstone that should terrify every investor, every homeowner, every person with a retirement account. Let me be very specific about what I am seeing, because this is not about being pessimistic or trying to scare people. This is about recognizing reality and preparing accordingly. There are 5 major warning signs in the real estate market right now that I believe could trigger the next financial crisis if they are not addressed. The first warning sign is commercial real estate, particularly office buildings. This is the most immediate and obvious threat, and I am genuinely shocked by how little attention it is getting from mainstream media and from regulators. The commercial real estate market is in crisis right now, not next year, not in 5 years. Right now. Here is what happened. The pandemic fundamentally changed how people work. Before 2020, the assumption was that white-collar workers would go to an office 5 days a week. That was the model that had existed for a century. Companies leased office space based on that assumption. They signed long-term leases, often 10 or 15 years, because they assumed they would need that space for the foreseeable future. Then suddenly everyone was working from home. Companies discovered that productivity did not collapse. In many cases it improved. Employees discovered they liked not commuting, liked having flexibility, liked being able to work from anywhere. And now, 5 years later, it is clear that we are never going back to the old model. Hybrid work is permanent. Many companies have gone fully remote. Even companies that want everyone in the office are struggling to enforce it because employees have leverage. The result is catastrophic for office real estate. Office utilization rates are still only 60 to 70% of pre-pandemic levels in most major cities. Vacancy rates in places like San Francisco, New York, Chicago, Los Angeles are at historic highs. In some markets, we are seeing vacancy rates of 30% or higher. That's not a temporary blip. That is a structural change. Now here is where it gets dangerous. These office buildings were financed with massive amounts of debt. Owners borrowed hundreds of millions, sometimes billions of dollars, to buy or develop these properties. They were able to service that debt because the buildings generated rental income. Tenants paid rent, landlords paid their mortgages, everyone was happy, but now the tenants are leaving. Leases are expiring and companies are not renewing, or they are taking half the space they used to have. Rents are falling because there's so much vacant space that landlords have to compete for the remaining tenants. Property values are plummeting. Buildings that were worth $500 million 3 years ago are now worth $200 million. Some cannot even find buyers at any price. What happens when property values crash while the debt stays the same? Defaults, bankruptcies, foreclosures. We are already seeing this. Major real estate companies are handing back the keys to their lenders. Properties are selling for 50 or 60 cents on the dollar compared to their previous values. And this is just the beginning. The second warning sign is who holds all this commercial real estate debt. The answer is regional banks. Small and mid-sized banks across America loaded up on commercial real estate loans over the past decade because the yields were attractive. These were not subprime mortgages to risky borrowers. These were loans to established real estate developers and investors secured by physical properties. It seemed safe. But when property values decline by 40 or 50%, those loans are underwater. The collateral is worth less than the loan amount, and when borrowers start defaulting, the banks have to take losses. For a large bank with a diversified portfolio, a few bad loans can be absorbed. But for smaller regional banks that concentrated heavily in commercial real estate, these losses can be existential. We already saw what happened with Silicon Valley Bank and First Republic and Signature Bank in 2023. Those failures were primarily about interest rate risk. But commercial real estate was a contributing factor. And I believe we will see more bank failures related to commercial real estate losses over the next 2 to 3 years. This creates a feedback loop that makes everything worse. When banks take losses, they become more cautious about lending. They tighten credit standards, they pull back from real estate lending entirely. This makes it harder for real estate owners to refinance their loans when they come due, which leads to more defaults, which leads to more bank losses, which leads to even tighter credit. It is a vicious cycle that can spiral out of control quickly. The third warning sign is the residential housing market. Now, this is more subtle than commercial real estate, but it is potentially even more dangerous because it affects so many more people directly. Housing prices in most American markets are at or near all-time highs. In many cities, the median home price is 8, 10, 12 times the median household income. That ratio is historically unprecedented. In a healthy housing market, homes cost 3 to 4 times household income. We are way beyond that. How did this happen? A combination of factors. Low interest rates for years made mortgages cheap, which allowed people to bid up prices. Limited housing supply in many markets because of restrictive zoning and building regulations. Institutional investors buying single-family homes as rental properties, competing with families trying to buy their first home. Foreign buyers parking money in American real estate. All of these factors push prices to unsustainable levels. Now interest rates have normalized. Mortgage rates went from 3% to 7% in the span of about 18 months. That dramatically changes the affordability equation. A family that could afford a $500,000 house at 3% interest can only afford a $350,000 house at 7%. The monthly payment is the same, but the purchase price is much lower. Logic would suggest that housing prices should have fallen to reflect this new reality, and in some markets they have fallen somewhat. But in most markets, prices have remained stubbornly high because current homeowners do not want to sell. They are locked into their low-rate mortgages. If they sell, they would have to buy a new home at the current high rates, so they stay put. This has created a frozen market. Transaction volumes have collapsed. Inventory is extremely low. First-time buyers cannot afford to enter the market. Existing homeowners cannot afford to move. The whole system is stuck. But here is the problem. This freeze cannot last forever. Eventually, people need to move. Job changes, divorces, deaths, retirements, growing families, shrinking families, life events force people to sell whether they want to or not. As more and more of these forced sales happen, as inventory increases, as buyers remain unable to afford current prices, something has to give. And when it gives, it could give quickly. Housing markets can go from frozen to panicked very fast. We saw this in 2008 and 2009. Once prices start falling, potential sellers rush to get out before prices fall further. This increases supply, which pushes prices down more. Buyers wait on the sidelines expecting better deals tomorrow. The market enters free fall. I am not predicting a 2008-style crash in residential housing. The lending standards today are much better than they were then. We do not have the same concentration of subprime mortgages and exotic loan products, but I am saying that housing prices in many markets are fundamentally disconnected from what people can afford, and some form of correction is inevitable. The fourth warning sign is the amount of debt in the system overall. Not just real estate debt, all debt, government debt, corporate debt, consumer debt. We have borrowed more money than at any point in human history, and we have done it at interest rates that seemed low but are now normalizing. The U.S. government is now paying over $1 trillion per year just in interest on the national debt. That is more than we spend on defense, more than we spend on Medicare. And it is growing rapidly as old debt issued at low rates is refinanced at higher rates. Corporate America loaded up on debt during the decade of low rates. Companies borrowed money to buy back their own stock, to fund acquisitions, to pay dividends. That made sense when you could borrow at 3%. But now those companies have to refinance at 6 or 7%. For companies already operating on thin margins, that increase in interest expense can turn profits into losses. Consumers are maxing out their credit cards. Consumer credit card debt recently exceeded $1 trillion for the first time in American history. The average credit card interest rate is now over 20%. People are paying these usurious rates because they have no choice. Their wages have not kept up with inflation. Their savings are depleted. They are borrowing to maintain their standard of living. Real estate does not exist in isolation from all of this debt. When consumers are stretched thin, they cannot afford rent increases. When companies are struggling with debt service, they downsize and need less office space. When the government is spending $1 trillion on interest, it has less money for infrastructure and programs that support economic growth. All of these factors feed back into real estate values. The fifth warning sign is the concentration of risk in ways that regulators do not fully understand. This is the one that scares me most because it is the hardest to see and the hardest to predict. In 2008, the risk was hidden in complex mortgage-backed securities and credit default swaps that even the people trading them did not fully understand. We had institutions making bets on bets on bets, with leverage layered on top of leverage. When it all unwound, nobody knew where the bodies were buried. Nobody knew which institutions were solvent. That uncertainty froze the entire financial system. Today, I see similar complexity and opacity in parts of the financial system. Private credit has exploded in size. These are loans made by non-bank lenders, private equity firms, hedge funds. The traditional banking system is heavily regulated. We have capital requirements, stress tests, regular examinations, but private credit operates largely outside that regulatory framework. How much private credit exposure is connected to real estate? How much leverage are these private lenders using? What happens to their portfolios when real estate values decline? Honestly, I do not think anyone fully knows the answers to these questions, and that lack of knowledge is itself a risk factor. Similarly, there are trillions of dollars in commercial mortgage-backed securities floating around the financial system. These are packages of commercial real estate loans that have been securitized and sold to investors. Pension funds own them. Insurance companies own them. Foreign governments own them. If the underlying loans start defaulting at elevated rates, who is exposed? How will those losses ripple through the system? These are the questions that keep me up at night. Not because I know a crisis is imminent, but because I know that when these hidden risks are finally revealed, it is usually too late to do anything about them. Now let me talk about why I think this could trigger something bigger than just a real estate downturn. Why I use the word collapse in describing the potential outcome. Financial crises are not linear. They are exponential. They start slowly with isolated problems that seem manageable. A few banks have trouble. A few properties sell at distressed prices. Experts reassure everyone that the problems are contained, that the system can absorb the losses, that there is no reason to panic. Then suddenly everything accelerates. The problems that seemed isolated turn out to be connected. Losses in one area reveal losses in another area. Confidence evaporates. Lenders stop lending. Buyers stop buying. The system freezes. What took months to build up unwinds in days. In 2008, this phase lasted from roughly September through November. In the span of about 10 weeks, we went from thinking the problems were manageable to watching the entire global financial system nearly collapse. Lehman failed. AIG had to be rescued. Money market funds broke the buck. The commercial paper market froze. Interbank lending stopped completely. The same dynamics could play out again with real estate as the trigger. Here's how I see it potentially unfolding. It starts with more commercial real estate defaults. Property owners with loans coming due cannot refinance because the properties are worth less than the loan amounts. They hand back the keys to the lenders. The lenders, mostly regional banks, have to recognize losses. As these losses accumulate, some banks fail. Maybe 3 or 4 mid-sized banks in different parts of the country. Each failure erodes confidence in the broader banking system. Depositors at other regional banks start wondering if their bank is next. They move their money to the largest banks that are perceived as too big to fail. This deposit flight puts more pressure on regional banks. They have to sell assets to meet withdrawals. If they are selling real estate loans or properties, they have to sell at distressed prices, which crystallizes more losses. The banks that were on the edge get pushed over the edge. At some point, the crisis spreads beyond just real estate and regional banks. Insurance companies that invested in commercial mortgage-backed securities have to take write-downs. Pension funds that invested in real estate see their portfolios decline in value. Private credit funds that made bridge loans to real estate developers face defaults. As losses multiply across different parts of the financial system, credit tightens everywhere. Banks pull back on lending, not just to real estate, but to businesses of all types. Credit card limits get reduced. Auto loans get harder to obtain. Mortgages require larger down payments and higher credit scores. This credit contraction slows the economy. Businesses that cannot get financing cut back on investment and hiring. Consumers who cannot borrow spend less. The economy tips into recession. A recession makes everything worse. Unemployment rises. People who lose their jobs cannot pay their mortgages. Residential real estate prices start falling, not just commercial. Companies that were barely surviving fail. More loans default, more banks take losses. This is the cascade effect. One domino knocking down the next, each one bigger than the last. It is how a real estate downturn becomes a financial crisis, becomes an economic collapse. Am I predicting this will definitely happen? There are many scenarios where the problems in real estate are gradually worked through without triggering a systemic crisis. Regulators could act preemptively. Banks could raise capital to absorb losses. The economy could remain strong enough to limit defaults. But I am saying the risk is much higher than most people realize. The vulnerabilities in the system are real. The potential for cascading failures is real. And most investors, most homeowners, most Americans are completely unprepared for what could happen. So what should you do? How do you prepare for a potential real estate-driven financial crisis? Let me share what I believe every intelligent person should be thinking about. First, understand your own exposure. Do you own real estate directly? What is it worth today versus what you paid? What is your mortgage situation? If property values fell 30%, would you be underwater? Do you own real estate indirectly through REITs or mutual funds or your pension? How would those investments perform in a real estate downturn? Most people have more real estate exposure than they realize. If you own your home, that is probably your largest single asset. If you have a retirement account, it probably owns some REITs or has exposure to financial companies that lend against real estate. If you work for a company that owns or leases significant real estate, your job could be affected by a real estate downturn. Second, reduce debt where possible in a financial crisis. Debt is what kills you. People who have little debt, who have savings, who live below their means, they can weather storms that destroy others. If you are carrying high-interest credit card debt, pay it off. If you have an adjustable rate mortgage, consider refinancing to a fixed rate even if the rate is higher. Certainty has value in uncertain times. Third, maintain liquidity, have cash on hand. Not everything in stocks or real estate or illiquid investments. Cash is boring. Cash earns minimal returns. But cash also does not go down in a crisis. Cash gives you options. If you lose your job, cash buys you time to find another one. If assets become cheap because others are forced to sell, cash lets you buy. The people who made fortunes in 2009 were people who had cash when everyone else needed to sell. Fourth, be skeptical of narratives. Every time I have lived through a crisis, the consensus right before it happened was that there was no crisis coming. In 2007, the consensus was that real estate prices could not fall nationally because they never had before. In 2000, the consensus was that traditional valuation metrics did not apply to technology companies. The consensus is almost always wrong at turning points. Right now, the consensus seems to be that the commercial real estate problems are contained, that regional bank issues were addressed after the 2023 failures, that the economy is resilient enough to absorb any shocks. Maybe that is right, but maybe it is the same kind of complacency that precedes every crisis. Fifth, think about what assets would perform well in a crisis scenario. Not because you should put everything into those assets, but because having some allocation can provide a hedge. Treasury bonds, especially short-term treasuries, have historically performed well during financial crises because investors flee to safety. Gold tends to hold its value during periods of financial stress. Stocks of companies with strong balance sheets, no debt, and consistent cash flows tend to decline less than the overall market. I am not giving you a specific portfolio allocation that depends on your individual circumstances. What I am saying is, think about scenarios. What happens to your net worth if commercial real estate crashes? What happens if we have a recession? What happens if banks fail? Run those scenarios and make sure you can survive them. 6. Pay attention to early warning signs. What should you watch for? Bank stock prices. If you see regional bank stocks falling sharply, that is a sign the market is pricing in trouble. Credit spreads. The difference between yields on corporate bonds and treasury bonds. When spreads widen, it means investors are demanding more compensation for taking risk, which usually means they are getting nervous. Transaction volumes in real estate markets. If transactions dry up, it often precedes price declines and, of course, news about defaults, foreclosures, and distressed sales in commercial real estate. Let me also talk about what I think policymakers should be doing, because individual preparation can only go so far. If the system fails, everyone suffers regardless of how prepared they are personally. Regulators need to be proactive, not reactive. Do not wait until banks fail to act. Require banks to increase capital reserves now, while they can still raise capital from private markets. Stress test specifically for commercial real estate scenarios. Make sure banks have enough cushion to absorb the losses that are coming. The Federal Reserve needs to think carefully about interest rate policy. Yes, inflation was a problem, and higher rates were necessary to control it. But monetary policy operates with a lag. The effects of high rates are still working through the system, and overly tight policy during a period of financial stress can make problems much worse. The Fed needs to be ready to provide liquidity if credit markets freeze. Congress needs to consider whether the regulatory framework for private credit is adequate. These non-bank lenders have grown enormously in size and importance. They are making loans that banks used to make, but they are not subject to the same oversight. If they start failing, the contagion could spread quickly. And frankly, policymakers need to have contingency plans. What happens if multiple regional banks fail simultaneously? What happens if commercial mortgage-backed securities start defaulting at high rates? What tools do we have to prevent a local problem from becoming a systemic crisis? I hope these plans exist. I am not certain they do. Let me close by putting this in a broader historical context. Throughout history, real estate has been at the center of the most devastating financial crises. The Panic of 1893 was driven by a railroad and real estate bubble. The Great Depression was triggered in part by real estate speculation in the 1920s. The savings and loan crisis of the 1980s and early 1990s cost taxpayers over $100 billion and was fundamentally about bad real estate loans. And of course, 2008 was the great financial crisis driven by the housing bubble. This is not coincidence. Real estate is unique among asset classes because of how much leverage is involved. People typically put 20% down or less when buying property. That means a relatively small decline in values can wipe out your equity entirely. When values decline broadly, when many properties are underwater at the same time, the leverage that amplified gains on the way up amplifies losses on the way down. Real estate is also unique because it is so interconnected with the banking system. Banks fund real estate through mortgages and construction loans and commercial loans. When real estate fails, banks fail, and when banks fail, the whole economy suffers. I have spent my entire career in banking. I love this industry. I believe in its importance to economic growth and prosperity, but I also understand its vulnerabilities better than most. And I am telling you that the vulnerabilities I see today in the real estate market and its connections to the banking system are serious. They deserve attention. They deserve preparation. Maybe I am wrong. Maybe the problems work themselves out gradually. Maybe property values stabilize. Maybe banks absorb the losses without crisis. I genuinely hope that is what happens, but hope is not a strategy. The time to prepare for a potential crisis is before it happens, not during it. The time to reduce risk is when you still have choices, not when you are forced to act. The time to build resilience is now. I have seen too many people, too many companies, too many institutions fail because they did not take warning signs seriously. They assumed things would work out. They assumed someone else would fix the problem. They assumed they would have time to prepare later. The warning signs are here. The vulnerabilities are real. Whether they result in a crisis depends on many factors, some within our control and some not. But what is within your control is how prepared you are, how much you understand about your own exposure, how much cushion you have to absorb shocks. Take these warnings seriously, evaluate your position, make adjustments where prudent, and hope that I am wrong, because if I am right, the next few years could be very difficult for anyone caught unprepared. The real estate crash that could trigger collapse is not a certainty, but it is a possibility that deserves your attention and your preparation. Let me share one more story that illustrates why I take these risks so seriously. In the fall of 2008, during the worst of the financial crisis, I was in a meeting where we were discussing whether a major financial institution would survive the night. Not the week, not the month, the night. The amount of money flowing out of that institution was so massive that there was a real question whether they would be able to open their doors the next morning. That is what a financial crisis looks like at its peak. Decisions that normally take months are made in hours. Institutions that took decades to build can fail in days. The wealth of millions of people can evaporate before they even realize what is happening. Most people have never experienced anything like that. Even in 2008, the worst of the crisis was largely hidden from public view. People saw their retirement accounts decline. They saw the news about bank failures, but they did not see the behind-the-scenes panic, the emergency calls at 3 in the morning, the negotiations that determined whether the financial system would survive. I saw it. I lived it. And I never want to see it again. That is why I sound the alarm when I see conditions that could lead to another crisis. Not to create panic, not to manipulate markets, but because I know what is at stake and I know how quickly things can spiral out of control once they start. The real estate market today has echoes of 2007 and 2008, not in the specific products or the exact structure of the risks. Those are different. But in the complacency, in the assumption that problems are contained, in the belief that someone else will deal with it before it becomes serious. I remember very clearly the attitude in 2007. Housing prices had been falling for about a year in many markets. The subprime mortgage market was clearly in trouble, but the consensus view was that it was a subprime problem, not a housing problem. It was contained, it would not spread. The broader economy was strong enough to absorb the losses. That consensus was catastrophically wrong. The subprime problem was not contained. It spread to prime mortgages, to commercial real estate, to the entire financial system. The broader economy was not strong enough to absorb the losses. Millions of people lost their homes, their jobs, their retirement savings. I see similar complacency today about commercial real estate. The attitude seems to be that office building problems are a niche issue. Regional bank stress was addressed last year. The economy is resilient. Problems will be worked through gradually maybe. Or maybe we are in the equivalent of 2007, looking at obvious warning signs and convincing ourselves they do not matter. I genuinely do not know which scenario will play out, but I know which one I am preparing for. Let me also address something I hear frequently, which is the argument that the government will step in and prevent any crisis from becoming too severe. The Fed will cut rates, the Treasury will bail out failing institutions, the FDIC will protect depositors, The government will not let the system fail. There is some truth to this. The government did step in massively in 2008 and 2009. Without that intervention, the crisis would have been far worse. The economy might not have recovered for a generation, but government intervention is not free. It comes with costs, and those costs have grown larger over time. The national debt has more than tripled since 2008. The Fed's balance sheet expanded from under $1 trillion before the crisis to nearly $9 trillion at its peak. We have used up much of our fiscal and monetary ammunition. If another crisis hits, the government can certainly act, but at what cost? More debt that future generations will have to service, more money printing that could fuel inflation, bailouts that create moral hazard and encourage more risk-taking in the future. There are limits to what government intervention can accomplish, and we may be closer to those limits than we realize. The assumption that the government will always save us is itself a form of complacency that can lead to excessive risk-taking. I also want to talk about something that does not get enough attention, which is the human cost of financial crises. It is easy to talk about abstract numbers, billions of dollars in losses, millions of homes foreclosed, but behind every number is a real person whose life was disrupted or destroyed in 2008 and 2009. I talked to people who lost everything, people who had worked their entire lives, done everything right, saved diligently, and watched their retirement accounts cut in half. People who bought homes at the wrong time through no fault of their own and ended up underwater, unable to sell, sometimes unable to make their payments. People who lost their jobs because their employers went out of business or cut back to survive. Financial crises destroy families, they destroy communities. They destroy the sense of security and optimism that allows people to plan for the future, to take risks, to pursue their dreams. The economic statistics eventually recover. GDP growth returns, unemployment falls. But the human damage lingers for years, sometimes decades. That's why preventing crises is so important. That is why warning about potential crises is not fear-mongering. It is responsible, because the cost of being unprepared is not just financial, it is human. If commercial real estate triggers a broader financial crisis, the people who will suffer most are not the wealthy. They have diversified portfolios, financial advisors, the ability to weather storms. The people who will suffer most are ordinary Americans, people whose retirement accounts are invested in things they do not fully understand. People who work for companies that depend on credit to operate, people who own homes in markets that could see significant price declines. These are the people I think about when I issue warnings like this, not institutional investors who have teams of analysts monitoring risks, but regular people who trust that the system is stable, that the experts are watching out for them, that crises like 2008 cannot happen again. I want those people to be aware, to understand their exposure, to make informed decisions, to not be blindsided if things go wrong. Because if there is another crisis, and I hope there is not, but if there is, the people who prepared will have options. The people who did not will be at the mercy of events beyond their control. This is not about being pessimistic. It is about being realistic. The financial system has vulnerabilities. Real estate is a major source of those vulnerabilities. Ignoring the risks does not make them go away. It just means you will be unprepared when they materialize. I have built my career on understanding risk, on trying to anticipate problems before they become crises, on preparing for scenarios that others dismiss as unlikely. That approach has served well through multiple cycles. It is the approach I recommend to anyone who will listen. The warning signs in real estate are real. The potential for a cascading crisis is real. Whether it happens or not depends on many factors, but your preparation is entirely within your control. Take advantage of that control while you still can. Real estate crashes have triggered some of the worst financial crises in history. The current environment has many of the characteristics that preceded previous crashes: excessive valuations, too much debt, hidden concentrations of risk, complacency about the potential for serious problems. History does not repeat exactly, but it rhymes. The specific mechanisms of the next crisis will be different from 2008, but the pattern of build-up and collapse, of warning signs ignored and problems dismissed until they become too large to contain, that pattern repeats with remarkable consistency. Learn from history. Pay attention to warning signs. Prepare for scenarios you hope will not happen. That is the best any of us can do in an uncertain world. And right now, with real estate showing the cracks, it is showing. Uncertainty is the only certainty we have.